Welcome. Okay, if you're a financial accounting 2 student trying to get your head around non-current assets, particularly property, plant, and equipment PPE, then you're absolutely in the right place.
Yeah, we're aiming to give you a really solid handle on the rules, the whole life cycle, really.
Exactly. From start to finish, we want to cut through the jargon and focus on the key international standards you need to nail down.
We know it feels like a lot. You've got IAS 16 is the main one for PPE, obviously. But then there's IAS 36 on impairment, super important, and IFRS 5 for when assets are, heading out the door, held for sale.
Right, and we'll touch on others too, like IAS 20 for grants, IAS 23 for borrowing costs. They all interconnect.
They really do. It's about how they work together.
And look, before we jump in, we really have to acknowledge the input from the model leader, Dr. Salah Hamad. His guidance really structures this whole area. It's vital stuff.
Oh, absolutely. His framework is key. This material covers a huge chunk of most companies' balance sheets. Getting it right is, well, it's critical.
Couldn't agree more. Okay, let's get into it. We're basically tracking an asset, how it gets onto the books, how we account for it while it's working, and what happens when it leaves. So, first things first, what actually makes something PPE under IAS 16? What are the absolute must-haves?
Okay, three main things. One, it's got to be tangible, physical. You can touch it.
Okay, physical?
Two, it's held for use. So not something you plan to sell quickly like inventory. It's for production or maybe renting out or just general admin purposes.
Right, used in the business.
Exactly. And three, you expect to use it for more than one accounting period, more than a year typically. If it ticks all those boxes, and it's material, of course, then it's likely PPE.
Got it. Tangible, held for use, more than one period. Now, once we've identified it, the rule is initial recognition at cost. But cost can be a bit slippery, can it? Especially if you build the asset yourself.
Oh, definitely. The core principle is that cost includes everything necessary to bring the asset to the location and condition needed for it to operate in the way management intended.
Necessary and directly attributable. That's the key phrase, isn't it?
That's the one. If you didn't have to spend it to get the asset ready for its intended use, then it shouldn't be capitalized. It should be expensed.
Okay, let's use an example. Building a factory, we clear the site beforehand, that cost.
Capitalize it. Absolutely necessary ground prep.
We hire surveyors to manage the construction work, their fees.
Capitalize. Directly related to the construction project. Professional fees.
And say we use our own employees, pulling them off other duties to work only on the construction, their wages for that time.
Capitalize that portion too. Their work is directly attributable to building the asset. If not for the construction, they wouldn't be doing that specific job.
Okay, makes sense. Now, the flip side. Our internal admin team spends hours processing invoices and paperwork for this project. We calculate their time and try to add a chunk of admin overhead to the asset cost. Why is that usually a no?
Because those general admin costs, well, they're part of running the business anyway,
Yeah.
right? Salaries, office costs, general paperwork handling, they'd likely be incurred whether you built that specific factory or not.
Ah, so not directly caused by the construction itself.
Exactly. They aren't an incremental cost directly tied to getting that asset ready. IAS 16 tries to stop companies loading up asset values with general overheads. That distinction is often tested.
Right, so the assets on the balance sheet, initial cost sorted, but then IAS 16 gives a big choice for what happens next, for how we measure it year after year.
That's right. A fundamental policy choice. And you have to apply it to an entire class of assets. You can use the cost model or the revaluation model.
This model sounds straightforward.
It is, relatively. It's just the initial cost, less all the depreciation you've charged so far, and less any impairment losses, which we'll get to. Stable, predictable.
And the revaluation model.
That's different. You periodically revalue the asset to its fair value. So the carrying amount becomes the fair value at the date of revaluation, less any subsequent depreciation. This introduces, well, potential volatility.
Well, because fair values go up and down. So thinking about reported profit and balance sheet stability, the revaluation model seems like it would have a bigger impact.
Absolutely. It reflects current values, which investors might like, but it definitely makes the balance sheet numbers move around more. The cost model is much smoother.
Now, if a company does choose the revaluation model, how do those ups and downs actually hit the accounts? This is where it gets interesting, particularly the difference between gains and losses.
Yes, there's a really important asymmetry here. If an asset is revalued upwards, that gain doesn't usually go through the profit or loss statement.
Not profit. Where does it go?
It goes to other comprehensive income, or OCI, and builds up in a separate reserve and equity, called the revaluation reserve or revaluation surplus. The idea is you haven't actually realized that gain by selling it, so it shouldn't boost operating profit.
Okay, so gains build up equity directly. What about losses, or when a previously revalued asset falls in value?
Well, generally a revaluation decrease is recognized as an expense in the profit or loss statement straight away.
So losses hit profit, gains don't. Seems a bit harsh.
Well, there's a catch. If there's already a credit balance in the revaluation reserve for that specific asset from previous gains, the loss first reduces that reserve. Only any excess loss over the existing reserve balance hits the profit or loss.
Okay, so you use up the previous unrealized gain first before you recognize a loss in profit. That makes more sense.
Exactly. It prevents recognizing a loss when overall for that asset it might still be above its original cost.
And whichever model we choose, cost or revaluation, we still have to depreciate the asset.
Absolutely.
Yeah.
Depreciation is mandatory under both. You need to allocate the depreciable amount systematically over the asset's useful life.
And systematically means using a consistent method.
Yes, straight line is common, just spreading the cost evenly. But you could use reducing balance, where depreciation is higher in early years, or even usage-based methods like machine hours, if that better reflects how the asset's economic benefits are consumed.
But the key is choosing a method that reflects the pattern and sticking to it, unless the pattern genuinely changes.
Precisely. Consistency is key.
Okay, let's tackle some specific costs that often cause confusion. Borrowing costs, first IAS 23. Why do we sometimes have to add interest costs to the asset's value?
Well, think about building something large, like that factory again. It takes time, and you probably had to borrow money to finance the construction. IAS 23 says if those borrowing costs are directly attributable to acquiring, constructing, or producing a qualifying asset, they must be capitalized.
Directly attributable again. And what makes an asset qualifying?
It's an asset that necessarily takes a substantial period of time to get ready for its intended use or sale. Think power plants, large buildings, maybe complex machinery, not something you buy off the shelf.
And there are rules about when you start and stop capitalizing the interest.
Yes, very specific rules. You start when you're incurring expenditures for the asset, incurring borrowing costs, and undertaking activities to prepare the asset. You must stop capitalizing as soon as the asset is substantially complete and ready for its intended use, even if you haven't actually started using it yet.
Right, you can't just keep adding interest indefinitely. Okay, next one. Government grants, IAS 20. Say the government gives you money specifically to help buy an environmentally friendly machine. Do you just book that as income right away?
Usually, no. It comes back to the matching principle. That grant is linked to the asset. The asset provides benefits over its useful life, and you recognize depreciation expense over that life.
So the grant income should be matched to that expense.
Exactly. The common way is to set up the grant as deferred income, essentially, a liability on the balance sheet. Then you release it to the profit or loss statement systematically over the asset's useful life, often in line with the depreciation charge.
So a $1 million grant for a machine with a 5-year life, you'd recognize, what, $200,000 of grant income each year alongside the depreciation?
That's the typical approach, yes. It matches the income recognition to the period the related costs are hitting the P&L.
Makes sense. Last one in this section, decommissioning costs. The cost to tear down the factory years from now, we know we'll have to do it. How does that fit in?
Right. This is an obligation you have now because you built the asset. Even though the cash outflow is way off in the future, accounting standards say you have to recognize a provision for that cost now.
But you don't know the exact amount, and it's decades away.
Correct. So you estimate the future cost and then discount it back to its present value. That present value amount is actually added to the cost of the asset right at the beginning.
Wow. Okay, so the future teardown cost increases the initial asset value. What happens to that liability, the provision, over time? Does it just sit there?
No, it increases each year.
Yeah.
Because you calculated it based on a present value, as time passes, you need to unwind the discount. This unwinding increases the liability.
And that increase, where does it go in the accounts?
This is key. The unwinding of the discount is charged as a finance cost in the profit or loss statement each year. It's not depreciation. It's treated like interest expense, reflecting the time value of money.
So if the discounted liability was, say, $4 million and the discount rate was 8%, you'd have a finance cost of $320,000 that year.
Exactly. That charge reflects the liability getting closer to its future settlement date.
Okay, we've got the asset, we're using it, dealing with costs, but sometimes things go wrong. The market changes, the asset gets damaged, its value might have dropped significantly. This brings us to impairment under IAS 36.
Yes, depreciation handles the normal wear and tear, but impairment is about significant, possibly sudden drops in value. IAS 36 requires you to check if an asset's carrying amount, its value on your balance sheet, might be higher than what you can actually recover from it.
And the benchmark for that check is the recoverable amount.
Precisely. The recoverable amount is defined as the higher of two things: the asset's value in use, the present value of the future cash flows you expect to generate by using the asset, or its fair value less costs to sell.
So what you could get if you sold it minus the selling costs.
Yeah.
And you take the higher of the two.
Yes, because you'd rationally choose the option that gives you more value back. If the asset's current carrying amount is more than this recoverable amount, then the asset is impaired.
And you have to write it down.
You have to write it down immediately to its recoverable amount. That write-down, the impairment loss, hits the profit or loss statement as an expense. And by the way, figuring out fair value often involves IFRS 13, the standard specifically about measuring fair value.
Right, they work together. Now that makes sense for an asset that directly generates cash, like a production line. But what about things like, I don't know, the head office building? It doesn't sell products directly. How do you test that for impairment?
Good question. That's where the concept of the cash generating unit, or CGU, comes in. You can't always assess an individual asset's recoverable amount if it doesn't generate its own cash inflows.
So you group assets together.
Yes. A CGU is the smallest identifiable group of assets that generates cash inflows that are largely independent of the cash inflows from other assets or groups of assets. You test the whole CGU, maybe the whole factory, or a whole division for impairment.
Okay, so you calculate the recoverable amount for the whole CGU and compare it to the carrying amount of all assets in that unit. If the CGU is impaired, say by $10 million, how do you spread that loss among the assets within the unit? Is it just pro rata?
Not quite. There's a specific order. First, you allocate the impairment loss to reduce any goodwill that has been allocated at CGU.
Goodwill gets hit first, down to zero if necessary.
Down to zero, the loss is big enough. Goodwill is seen as the most easily impaired part. Only after goodwill is reduced, potentially to zero, is any remaining impairment loss allocated to the other assets in the CGU on a pro rata basis, based on their carrying amounts.
Got it. Goodwill first, then spread the rest proportionally across the tangible and other intangible assets. That's a crucial detail. All right, we're nearing the end of the asset's journey with the company. Let's talk about how it leaves the balance sheet. First, simple disposal, we sell it. If it was an asset we'd been revaluing, how does the profit or loss calculation work?
The calculation for the profit or loss statement itself is straightforward. It's simply the net proceeds you get from selling it minus its carrying amount at the time of sale.
So sale price less book value goes to P&L.
Exactly. Gain or loss on disposal reported in the income statement.
But hang on, if it was a revalued asset, we might have that revaluation reserve sitting in equity related to past upward revaluations.
Right.
What happens to that balance when the asset is sold? Does it suddenly flow through profit?
No, and this is a really important point. That balance in the revaluation reserve related to the specific asset sold is now considered realized. It's transferred directly from the revaluation reserve to retained earnings.
Directly within equity. It bypasses the P&L completely.
Completely bypasses the P&L. Remember, the original gain didn't go through P&L, so the realization of that gain upon disposal also stays out of P&L. It's just a movement between two equity accounts. This impacts things like return on equity calculations.
Okay, that's a critical distinction. Now, the other way an asset might exit is if management decides firmly to sell it, even before a buyer is found. This triggers IFRS 5, non-current assets held for sale.
That's right. When an asset meets the specific criteria to be classified as held for sale, its accounting treatment changes quite significantly.
How so? What's the main change?
The biggest immediate change is that you stop depreciating it. The logic is that you're now planning to recover the asset's value through selling it, not through using it over time.
No more depreciation. Okay. And how is it measured on the balance sheet from that point?
It has to be measured at the lower of its current carrying amount, just before classification, and its fair value less cost to sell.
Lower of the two. So often this classification might trigger an immediate write-down if the expected sale value is less than its book value.
Very often, yes. You might recognize an impairment loss at the point of classification to get it down to that fair value, less cost to sell number.
And finally, what does it actually take to classify an asset as held for sale? Can a manager just say, yeah, we'll probably sell that next year?
Oh no, IFRS 5 is much stricter than that. The sale has to be highly probable, and that means several criteria must all be met.
Such as?
Management must be committed to a plan to sell. There must be an active program underway to find a buyer. The asset has to be actively marketed at a price that's reasonable compared to its current fair value. And crucially, the sale is expected to be completed within 1 year from the date of classification, although there are some exceptions for delays beyond the entity's control.
So it requires real commitment and action, not just intention. Hashtag tag tag out trade track.
And there we have it. We've really traced the journey, haven't we? From IS 16's rules on getting PPE onto the books, adding in those complex costs like borrowing and decommissioning, checking its value with IS 636 impairment tests, and finally looking at how it exits via disposal or IFRS 5.
Yeah, covering the initial capitalization, the cost versus revaluation debate, the matching of grants, the crucial role of CGUs in impairment.
And that often missed detail about the revaluation reserve transfer on disposal. Understanding not just what the rules are, but why they work the way they do. Why some things hit profit and others go straight to equity. That's really the key.
Absolutely. We hope this breakdown helps you navigate this complex but essential area of financial reporting.
And once again, a thank you to Dr. Salah Hamad for providing the solid groundwork for understanding these non-current asset standards.
So as you continue your studies, here's something to think about. We talked about the cost model versus the revaluation model. The revaluation model obviously introduces balance sheet volatility with changing fair values. But thinking about the long-term reported financial performance, the profit figures over time, which specific aspect of the revaluation model do you think has the most fundamental structural impact? Is it the periodic ups and downs hitting OCI or P&L? Is it the higher depreciation charge based on revalued amounts? Or is it that final reserve transfer upon disposal? Why? Something to mull over as you really get to grips with these standards. Good luck with your studies.